Imagine you are driving down the highway and the speedometer says you are going 60 miles per hour.
Right. You feel like you're making great time.
Exactly. You feel great about your progress. But then you look out the window and you realize you are, like, barely passing the trees.
Oh, yeah, that is a weird feeling.
Right. You are putting your foot on the gas. The dashboard definitely says 60, but relative to the actual road, you are only creeping along at maybe 20.
It is super disorienting.
It really is. And that disconnect, that gap between what the dashboard tells you and your actual forward momentum is, well, it is exactly what happens when you look at your investment portfolio today.
It is the ultimate mirage, honestly. We rely on those, precise glowing numbers on our banking apps to feel in control of our financial momentum.
Because they look so objective.
Exactly. They look like hard data, but they often completely mask the underlying reality of what is actually happening to our wealth.
Welcome to today's deep dive. If you are listening to this, you are probably trying to figure out why your accounts say you are making money, but you still feel like you are falling behind every single time you go to the grocery store.
Which is a very common feeling right now, for a lot of people.
Oh, for sure. We are pulling insights from a single, really critical source today. We have excerpts from the Investor's Guide to Real Rate of Return.
And, knowledge is most valuable when it is actually understood and applied. Too many people are driving their financial lives completely blind to the reality outside their windows.
Yeah, just staring at the dashboard.
Right, trusting a dashboard that is structurally designed to show them a better speed than they are actually traveling.
Okay, let's unpack this. We are decoding the vital difference between the sticker price of an investment's performance and what that money can actually buy you in the real world.
The true purchasing power.
Exactly. Consider this your shortcut to looking at capital growth without the illusion. So, let's start with the fundamental tension here. The nominal rate versus the real rate of return.
Right, so we all understand the basic premise of inflation, right?
That a dollar buys less today than it did, say, a decade ago.
Yes, exactly. But the nominal rate, which is that advertised percentage you see on a savings account or a CD, it completely ignores that reality.
It just pretends inflation doesn't exist.
Basically, yeah.
Yeah.
It is simply the stated interest rate before any macroeconomic forces are taken into account.
So that is the 60 miles per hour on the broken dashboard.
Spot on. Now, the real rate of return is the only metric that calculates your true purchasing power.
Okay, so how do we get that number?
You take that advertised profit, the nominal rate, and you adjust it for the reality of rising prices. And what's fascinating here is that the financial industry relies quite heavily on us focusing solely on the nominal number.
Because it is bigger.
Oh, much bigger. Since inflation is a constant humming presence in modern economies, nominal rates are almost always significantly higher than real rates.
Is there ever a time when they aren't?
Well, the only time they flip is during incredibly rare periods of deflation.
When prices actually drop. Which, yeah, doesn't happen often. That makes marketing financial products a whole lot easier for the banks, I bet.
Oh, absolutely.
I like to visualize this gap by thinking about an airport moving walkway. You know those long, flat escalators in the terminal?
Oh, yeah, the ones where you feel like a superhero walking on them?
Yes. You step onto one, and you are walking at a brisk, confident pace. That walking speed, that is your nominal growth. You feel like you are totally crushing it.
Except in this scenario, the walkway is actually operating in the opposite direction.
Exactly. That is the catch. You are taking steps, you are putting in the effort, generating that nominal growth, but your actual progress through the nominal, like your real growth, is incredibly slow.
Because the floor itself is pushing against you.
Right. That moving floor is inflation.
Yeah.
If you walk at 5 miles an hour, but the belt is moving against you at 3 miles an hour, your actual speed toward your departure gate is a sluggish 2 miles an hour.
I love that. That visualization captures the illusion perfectly. Because, looking down at your feet gives you this false sense of security.
You see your legs moving fast.
Yeah, you see the effort. But you have to look at the walls of the airport to gauge your true speed relative to your destination.
That makes total sense.
The real rate of return forces you to look at the walls.
Well, let's run the math on a realistic scenario just to see how much ground we are actually losing to that moving floor.
Let's do it.
Say you have saved up $10,000 for a car. Being a responsible planner, you decide to, park it in an investment for a year first.
Because you want a cash cushion left over after you drive off the lot? Smart move?
Exactly. So we find an investment paying a nominal interest rate of 5%.
Okay, 5%, not bad.
Right. You let that $10,000 sit there for 12 months. At the end of the year, you check your app, and boom, you have $10,500.
So your nominal gain is 500. You feel fantastic, ready to hit the dealership?
Wait, so if my app says I am up 500 bucks, but I know the consumer price index is running hot, let's say inflation was 3% over that year. Am I supposed to just mentally chop my returns down?
Basically, yes.
But the money is still physically sitting in my account. The 500 is there.
The money is there, sure, but the dealership has not been frozen in time.
Right.
Because of that 3% inflation, the exact same car that cost $10,000 a year ago now costs $10,300.
Ouch.
Yeah. So you walk in, hand over the cash for the vehicle, and you're expecting to walk out with that clean $500 cushion you saw on your screen.
But you're actually only walking away with $200.
Exactly. $200 is your actual increase in purchasing power.
Wow.
Your real rate of return is exactly 2%. You take your 5% nominal rate, subtract the 3% inflation rate, and your true profit is slashed by more than half.
So I took on the risk of tying up my money for a year, only to gain a tiny fraction of the value I thought I was earning.
That is the harsh reality of it, yeah.
Here's where it gets really interesting, though. If the real rate is the only thing that dictates whether we can actually afford the car or the groceries or, the retirement house, why do investment products only ever advertise the nominal rate?
This is a great question.
Is there, a strict regulatory reason they can't advertise real rates? Or is this purely a psychological game?
Well, it raises an important question about how financial products are structured and sold. The institutions issuing these products, like banks or corporate bond issuers, they can only contractually guarantee their end of the deal.
Oh, I see.
They can promise you a 5% yield based on their internal lending models, but they cannot predict, control, or guarantee macroeconomic factors.
Like federal inflation rates.
Exactly. So functionally, they really have to advertise the nominal rate. They were just stating what they will pay you.
But let's be honest, it is also incredibly convenient for them because human beings are wired to chase bigger numbers.
Oh, it absolutely plays into behavioral psychology. A banner that says earn 5% guaranteed looks fantastic on a billboard.
It really does.
But a banner that says earn a real return of 2% after we factor in anticipated inflation, that does not drive deposits.
No, nobody is pulling over to sign up for that.
Right. We suffer from something economists often call money illusion. We have an inherent bias toward the nominal number because it represents tangible, countable cash in our accounts.
Even if the invisible purchasing power of that cash is just quietly evaporating.
Precisely.
Man. So if nominal rates are mostly an illusion masking our true speed, then the late 1970s and early 1980s weren't a massive boom for savers.
Not at all.
It was arguably the greatest financial illusion of the century. Let's shift our focus to that era.
Our source material highlights this specific period because it serves as the ultimate cautionary tale for everything we are discussing today.
The stagflation era.
Yes, we are talking about a period of explosive inflation.
I want to paint a picture for you listening right now. Imagine walking into your local bank today and seeing a massive sign in the window offering a 10, 11, or even 12% guaranteed return on a standard savings account.
People would lose their minds.
Seriously, people would be emptying their checking accounts to lock in those yields.
To a modern investor accustomed to, minimal interest on cash deposits, it sounds like an absolute gold rush.
It sounds like free money.
And at the time, people genuinely felt they were getting rich just by leaving their money parked safely in a vault. The nominal balances were skyrocketing month after month.
But the moving walkway was cranked up to a terrifying speed.
It was. Prices across the broader economy were surging. The data from the text shows inflation hit 11.25% in 1979.
11%.
And then it spiked even further to 13.5% in 1980.
Okay, so what does this all mean for you? If you were that investor in 1980, doing a victory lap over your 12% yield, you were actively getting poorer.
You had a negative real rate of return.
Oof.
A 12% nominal gain minus 13.5% inflation leaves you with negative 1.55%.
So the profits from those astronomical interest rates were entirely consumed by the collapsing purchasing power of the dollar.
Exactly. Every single day, your money sat in that high-yield account. It could buy fewer groceries, less gasoline, less housing.
Despite the paper balance going up.
Yes, the numbers on the screen looked great, but the reality was grim.
Chasing high nominal yields in a high inflation environment is, well, it's like sprinting on that moving walkway when it is going faster than you can possibly
You
run.
are just exhausting yourself.
Right. You are exhausted. You are putting in maximum effort. You feel like you are doing everything right by saving your money, but you are being pushed backward relative to your destination.
It is a vital reminder to always check the macroeconomic floor before celebrating the interest rate.
That is a great way to put it.
Evaluating true investment performance requires immense discipline. You have to actively resist the comfort of the nominal dashboard.
Okay, we know the trap. We know we need to look at the walls of the airport to find our real speed. But how do we actually do that in real time?
That is the tricky part.
Because if I want to calculate my real rate of return today, right now, I run into a massive mechanical wall highlighted in the text. I don't actually know what inflation is today.
Right. The practical application of real rates introduces a significant hurdle here. Inflation is what economists classify as a trailing indicator,
Meaning what exactly?
meaning you cannot measure it in the present tense.
Because inflation isn't just one number or one price tag.
Exactly. You literally have to wait for millions of transactions to happen across the entire country, let the month or the quarter end, and then wait for someone to aggregate all that data.
So it is always old news by the time we see it.
Yes. The underlying measurement relies on tracking a massive, diverse basket of selected goods and services. You need the data on everything from milk prices to rent to airline tickets.
That is a lot of data to crunch.
It is. By the time you gather that data, crunch the numbers, and publish the inflation rate, the economic reality it describes is already firmly in the past.
Wow.
Trailing indicators reveal underlying trends beautifully, but they completely delay the recognition of turning points.
Meaning, I don't know that inflation has suddenly spiked or dropped until the damage or the benefit is already baked into my portfolio.
Unfortunately, yes.
It is like trying to steer a massive cargo ship by only looking at the wake it leaves behind in the water.
Oh, that is a really good analogy.
The wake is the trailing indicator. It tells you exactly where you have been and how fast you were going 10 minutes ago, but you have to use that historical churned up water to guess where you are pointing the ship right now.
A very apt description of the investor's dilemma. We are always reacting to old news.
It is a tough position to be in.
It is. And as a brief aside, the text notes that the term trailing is also used in day trading, like a trailing stop order. But in our macroeconomic context, it is entirely about this unavoidable backward-looking delay.
Right, the delay is the key issue here.
And unfortunately, that trailing wake of inflation isn't the only drag on the ship. If we are serious about calculating true, usable wealth, we have to subtract taxes and fees.
Oh man, the silent killers of compounding interest?
They really are.
Yeah.
They systematically erode the final number. The government taxes your nominal gains, not your real gains.
Wait, really?
Yes, you pay capital gains taxes on that illusory 5% profit we talked about in the core example.
Even if inflation wiped most of it out?
Even then.
Yep.
And furthermore, the fund managers taking a 1 or 2% management fee are also taking their cut off the top, regardless of what the real rate of return is.
Okay, let's run that through the filter of a standard retirement account. Say my portfolio grows by 8% nominally this year.
A solid year.
Right. And inflation is running at 3%. So my real return before any other costs is 5%.
Correct. But then your brokerage charges a 1% management fee.
Okay, bringing my return down to 4%.
And then taxes take another 1% equivalent off your overall portfolio growth.
Jeez. Suddenly, my in-your-pocket true purchasing power increase is just 3%.
Exactly. From an advertised 8% all the way down to 3%.
If inflation is the current pushing against the ship, taxes and fees are the barnacles growing on the hull.
That is exactly what they are.
It is this constant silent friction. If you aren't calculating them into your journey, you are going to arrive at your destination years later than you planned, wondering where all your supplies went.
This is why evaluating your portfolio strictly through a nominal lens is financially dangerous. A realistic view of long-term financial growth demands stripping away the illusions.
You have to face the music.
You must continuously subtract the trailing inflation, the taxes, and the management fees to find the raw truth of your purchasing power.
Which brings us back to you listening right now. We set out today to decode the gap between the sticker price of your investments and your actual buying power.
We covered a lot of ground.
We really did. We have explored how the moving walkway works against your savings, how a 12% return can actually make you poorer, and why steering by the wake of trailing indicators and hidden fees makes tracking your progress difficult, but, absolutely essential.
If we connect this to the bigger picture, assessing your wealth through the lens of real rates isn't just an academic exercise for economists.
It feels very personal.
It is a fundamental survival skill. It changes how you allocate assets, how you view risk, and ultimately how you plan for your future. The math forces you to confront reality.
So, what stands out to you about your own savings after hearing this? Are you looking at the dashboard or are you looking out the window?
It is a tough question to ask yourself.
Take 10 minutes this week to actually run the math on your biggest investment account.
Mhm.
Subtract the current trailing inflation rate, subtract your fund's expense ratio, and find your real speed.
It is an exercise that frequently yields sobering results, but clarity is always better than comfort.
I love that. Clarity over comfort. Before we wrap up, though, I want to leave you with one final thought to mull over. We have spent this entire deep dive looking at inflation as the enemy of the saver.
Right, the force eating away your purchasing power.
Exactly. But the text gives us a very specific definition that flips this dynamic entirely on its head.
Oh, this is a great point.
It notes that a real interest rate dictates the real yield to the lender, but it also dictates the real cost of funds to the borrower.
The other side of the ledger.
Think about the mechanics of this. If inflation is the enemy of savings because it eats away the value of currency.
Doesn't that mean it also eats away the real value of debt?
Exactly. The moving walkway suddenly pushes your debt away from you.
That is wild to think about.
Let's say you lock in a 30-year fixed-rate mortgage today. And let's say over the next decade, inflation runs unusually hot.
Okay, so prices are going up everywhere.
Right. You are paying the bank back every single month with currency that effectively buys less and less.
Oh, wow.
The nominal amount you owe stays exactly the same, but the real heavy burden of that debt on your life is shrinking. You are paying for a past purchase with cheaper dollars.
You're essentially shorting the dollar against your own house.
Could inflation actually be a secret advantage to you as a borrower? It is fascinating to realize that the exact same macroeconomic force that acts as a villain to your savings account could potentially be a massive, silent ally to your long-term fixed debt.
It completely changes how you look at a mortgage.
It really does. Depending on whether you are saving or borrowing, that broken dashboard might just be working in your favor. Ponder that next time you step onto a moving walkway. Until next time, keep diving deep.